What's up, guys? Welcome back to Taxes Made Simple. I'm your host, Karlton Dennis, and in today's video, we're going to be talking all about trusts and wills. I'm going to explain the key differences between trusts and wills, and I'm also going to let you know whether you need one or both of these financial instruments for your estate planning. Now, if you're wondering what's the best way to pass assets down to your loved ones, this is the video for you. I'm going to make sure that I cover everything you need to know, but I need you to stay until the end to learn one very important option that you have as a taxpayer. So let's dive in. All right, guys, first thing that we have to cover is what is a trust? Before we start talking about what the better option is and whether or not you need both, let's first go over what exactly a trust is and what wills are. Let's start off with the trust. To put it simply, a trust is a fiduciary arrangement in which a third party, known as a trustee, holds assets on behalf of a beneficiary or beneficiaries. Trustees can be lawyers, they can be family members, they can be accountants, they can be companies, etc. There are many different kinds of trusts. However, trusts are divided into two main categories: revocable trust and irrevocable trust. A revocable trust, which is also known as a living trust, is a trust that can be altered or changed at any time. This means that even after it is set up, it is not set in stone. With revocable trusts, the grantor or the person who sets up the trust can name himself or herself as a trustee if he or she wishes. So if you set up a revocable trust and name yourself the trustee, then you will still retain complete control over the assets that are inside of the trust that you're going to move into it. Now, the next thing we have to talk about is what about the irrevocable trust and when does it make sense to have one? An irrevocable trust is a trust that cannot be dissolved or altered after it is set up. It is set in stone and final, and once the assets are given over to the trustee, they remain in the trustee's possession until they are distributed following the death or incapacitation of the grantor. So irrevocable trusts are the more intense and ironclad option when it comes to the trust. But what is a will? You see, a will is a document in which a person writes down how they want their property to be distributed. Executors, who are the people responsible for managing the assets and distributing them, are also commonly named in the wills. The purpose of a will is just to make sure that a person is able to distribute his or her assets to the people he or she wants to at the time of his or her death. Now, many different property types are commonly included in wills. For example, a will might include cash, it can include real estate, it can include stocks, it can include bonds, it can include royalties, it can include artwork, it can include jewelry, and many other things. But the combined total of all the property that a person owns when he or she dies is known as an estate. Now, the next thing we have to cover is what is the difference between a trust and a will. One of the key differences between the trust and wills is that wills only go into effect after you die. Trusts, on the other hand, can go into effect before you die. In fact, you can set up a trust today. It can go into effect whenever you want it to. So trusts have more flexibility in terms of time. Also, oftentimes with a trust, you can skip the probate process entirely. The probate process is the process in which a court recognizes a will, appoints the executor, and then assets are distributed according to the will. Also, during the probate process, any relevant taxes such as estate taxes have to be paid. So this is a very popular conversation to have with your tax strategist around how to make sure that you can avoid estate taxes. Now, when it comes to irrevocable trust, you're usually not subject to the estate tax. So you can save a significant amount of money by having an irrevocable trust as opposed to just having just a will. Another benefit of trust is that they can go into effect if you are incapacitated. For example, you fall into a coma. This is different from wills, which usually only go into effect when the person dies. So if you have a trust, it means that you can better take care of your loved ones in the event that you're incapacitated but are still alive. So this is important when it comes to building wealth strategically. For many people, this is an important benefit to building wealth strategically. This is because a person could hypothetically be incapacitated for many years before dying, and during that time, many people would rather make sure that their assets are distributed to their loved ones as opposed to having to wait until the death occurs. Guys, these are difficult conversations to have, but as a tax strategist, I have to have them. Trusts also give you greater control over how the assets can be distributed. For example, with a trust, it is easy to set up controls for how and when the assets are going to get distributed. Could you imagine that you have a grandson and you want to distribute $1,000 a month to him after he turns 23? Well, guess what? You can do that with a trust. Well, with a will, on the other hand, all of the assets are usually turned over to the beneficiaries very quickly following a person's death, but the person has to die. Many people find this to be less than ideal. That is why they end up setting up trusts while they're alive, so they can trust that their assets are going to be passed on to their beneficiaries. Get what I'm saying? Now, do wills have any advantage over trusts? Yes, even though trusts have advantages over wills, wills do have some key advantages that we still need to talk about. For example, if you have children, you can actually name a legal guardian in the will. Also, wills can be significantly simpler to set up compared to trusts. Some people still handwrite their wills on a sheet of blank paper. This will can be legitimate as long as there is a witness and as long as they're properly proven in court. A will that was written without a witness present is known as what's called a holographic will. Some states do not allow holographic wills due to the potential for fraud. Now, another benefit of wills is that with a will, you do not have to ask anyone else to be a trustee and then manage your assets on your behalf. So for people who prefer to manage their own assets to a certain extent, this can be desirable. You can technically manage your own assets with a revocable trust, but can't with an irrevocable trust because the irrevocable trust has all the assets. You can only just control them. The irrevocable trust essentially owns the assets. You can maneuver assets around, and hence the concept own nothing, control everything, but you're truly not 100% in control of those assets. Now, with an irrevocable trust, the assets literally leave your possession once you put them into the trust. The trust now owns those assets. You're just in control of them. Makes sense? Now, let's go over some of the disadvantages of wills. The disadvantages of wills are that it is very, very, very difficult to dodge the probate process and estate taxes with just wills. So not all estates are large enough to be subject to estate taxes, I get it. But if your estate is large enough, then you will most likely be forced to pay the estate tax, which can be pretty hefty. Now, sometimes wills are challenging during the probate process, which can be a real nightmare for people who are involved. Another disadvantage of a will is that they are public records, so anyone can see which assets are passed down in a will. So if you would like to keep your estate private and you have other family members and previous ex-wives, and they might come into the situation, this could be a little bit scary for you. So my question is which is a better option, trust or a will? And question is, do you need both? The first thing that I will say is that both trusts and wills can be used effectively to pass on assets to beneficiaries and to skip the probate process. They are both useful financial instruments. However, with that being said, both trusts and wills have their own pros and cons. With trusts, it is possible to skip the probate process and estate taxes as we have discussed, but with wills, it can be simpler and easier to create, and they allow you to name a guardian such as your children. So the option that is right for you will depend heavily on your needs and your situation. It's not necessary to have both a trust and a will unless you need both a trust and will, but it can be helpful. For example, you can use a trust to distribute the majority of your assets to your beneficiaries over a period of time, but you can still have a will to name a guardian for your children or to make sure that some assets are distributed immediately following the date of your death. Now, generally speaking, if your top priority is to reduce your tax burdens, then you should probably look at these trusts. If your top priority is simplicity, then you should probably look at establishing a will. If you want the best of both worlds, then considering getting both and having a conversation with an estate attorney. If you have a significant amount of assets that you would like to pass on to your beneficiaries, then you should strongly consider setting up a will or a trust. Some people put this off until it's too late, and I hate to see it. And they don't get to choose how their assets get distributed because it's too late. If you would like to set up a trust or a will, and if you need help, then feel free to get in touch with my company by clicking on the link in the description below. We would be happy to sit down and have a conversation with you to get you situated with my attorneys to be able to help you set up your estate plan. As always, guys, don't forget to hit the like button and don't forget to comment and subscribe. I'm going to see you on the next video, but before we head out, I wanted to make sure I shared something with you. If you're somebody that's sitting right now watching this video, learning from me and building wealth strategically, then a part of building wealth is probably owning assets that you're going to pass off to your beneficiaries. What better way to do that than to go into rental real estate? What I've done is I put a link down below on a training that's going to teach you how to use real estate to build up cash flow for yourself while at the same time reducing the taxes on W-2 income as well as 1099 income. I'm going to show you a way in which you can strategically manage just a small amount of your portfolio to show the IRS that you can use the losses from rental real estate to offset your W-2 and 1099 income. I look forward to seeing you in the training below. Until in the next video, cheers.